Understanding money market yield, a comprehensive guide. The money market yield is an essential concept for investors looking to make the most out of their short-term investments in highly liquid securities. This article explores what money market yield is, how it is calculated, typical yields, and the advantages and disadvantages of investing in the money market. What is money market yield? The money market yield represents the interest earned from investing in highly liquid, short-term financial instruments with maturities of less than 1 year. Common examples of these instruments include negotiable certificates of deposit, CDs, U.S. Treasury bills, T-bills, municipal notes, commercial paper. Money market yield is derived from the holding period yield, modified to reflect a 360-day bank year. This makes it an important metric for investors who want to compare short-term investment returns. Key takeaways. Money market yield indicates the expected return on money market instruments. The money market serves as a platform for purchasing and selling short-term debt products. Individual investors can access this market through money market mutual funds, treasury bills, or bank money market accounts. Understanding the money market. The money market forms part of the broader financial landscape that facilitates the exchange of short-term and highly liquid financial instruments. It plays a crucial role in the financial system by connecting those who need to borrow, such as businesses and governments, with those who have surplus funds to lend, typically banks and investors. Major participants. 1. Banks use the money market for interbank lending and to meet reserve requirements. 2. Money market funds pool investors' funds to purchase a diversified range of money market instruments. 3. Brokers and dealers facilitate trades between buyers and sellers in the market. Money market securities. Treasury bills, T-bills. Certificates of deposit, CDs. Commercial paper. Repurchase agreements, repos. Eurodollar deposits. The securities within the money market generally exhibit low default risk, which leads to lower yields compared to equities and longer-term bonds, although they usually offer higher returns than standard savings accounts. How to calculate money market yield. Despite interest rates typically being quoted on an annual basis, it's essential to understand how to calculate money market yields accurately. The general formula used is \text money market yield equals \frac \text face value purchase price \text purchase price times \left \frac 360 \text time to maturity \right. Example calculation. For instance, consider a T-bill with a face value of $100,000 sold at $98,000 and maturing in 180 days. The calculation would be \text money market yield equals \frac 100,000 to 98,000 98,000 times left \frac 360 180 right equals \frac 2,000 98,000 times 2 equals 0.0204 times 2 equals 0.0408 text or 4.08 %. Bank discount yield. An alternative way to express money market yield is through the bank discount yield, which calculates interest based on the face value instead of the purchase price. However, money market yield remains a more accurate representation that offers insights for investment comparison. Typical money market yields. Money market accounts and securities typically yield between 0.01% and 4%, depending on factors like the financial institution and the amount deposited. Higher yields are often reserved for larger initial investments. 7-day yield on money market. The 7-day yield offers investors insight into the short-term return of money market instruments by comparing the current price with the price from 7 days prior, adjusted by an annualization factor. Advantages and disadvantages of money market accounts. Advantages. 1. Liquidity. Funds can be accessed quickly, making them suitable for emergency savings and short-term goals. 2. Safety. Generally low default risk, especially with government-backed securities. 3. Higher returns than savings accounts. Investors often see a better yield compared to traditional savings options. Disadvantages. 1. Lower yield compared to other investments. Money market accounts typically offer lower returns than stocks and bonds. 2. Transaction limits. Many money market accounts have restrictions on the number of transactions allowed monthly. 3. Minimum balance requirements. Some accounts require maintaining a minimum balance to avoid fees or earn interest. Conclusion. The money market yield is a vital part of managing short-term investments, offering a safe and liquid means of generating interest income. While it may not provide high returns, understanding the money market landscape can help investors make more informed decisions about their financial portfolios. By leveraging money market instruments, investors can effectively put their idle cash to work while minimizing risk and maintaining liquidity.